Your money is dying right now, and you don't even know it. No alarm goes off, no notification hits your phone, no headline warns you. It just happens, quietly, every single day. That's inflation. At a normal 3% a year, $100,000 sitting in your bank account is only worth $97,000 in buying power 12 months from now. After 10 years, just $74,000 in real purchasing power. After 20 years, you're down to roughly $55,000, nearly half your money gone, without you spending a single dollar, without a market crash, without a single bad investment. And if inflation runs hotter, 5%, 6%, 7%, the damage accelerates fast. That's not a guess, that's math. And it's happening to your money right now while it sits there doing nothing. Here's the truth almost nobody tells you. The wealthy aren't smarter than you. They don't have a secret financial gene. What they have is one simple rule they live by. Every idle dollar is a missed opportunity. They treat their cash exactly the way a farmer treats land. A farmer never lets fertile soil sit empty. Every acre is planted, every acre produces. The wealthy think about money the same way. Every dollar they don't need for today gets put to work, generating income, building equity, compounding in the background while they sleep. In the next few minutes, I'm going to walk you through 7 proven ways to do exactly that. Turn money that's just sitting there into money that works for you every single day. Dividend-paying stocks. The simplest place to start is dividend stocks. When you buy shares of a dividend-paying company, think Coca-Cola, Johnson & Johnson, Realty Income, you own a slice of a business that sends you a check every quarter just for holding on. A well-built portfolio realistically yields 3% to 5% a year before any growth in share price. The real magic is reinvesting those dividends instead of spending them, a feature most brokerages offer automatically called a DRIP. Run the math. $100,000 invested at a 4% yield with 6% average annual growth can realistically grow into $600,000 to $700,000 over 20 years. 6 to 7 times your money with zero speculation, just patience. Watch the payout ratio. 40 to 60% is healthy. Above 80%, be cautious. Rental real estate. Real estate has created more millionaires than almost any other asset class, and it's not complicated why. First, cash flow. Rent that hits your account every month after expenses, often 6% to 10% of the property's value yearly. Second, appreciation. Properties tend to rise in value as land stays scarce. Third, the real secret weapon, leverage. With a mortgage, you can control a $400,000 property using only $80,000 to $100,000 of your own cash, and any appreciation belongs to you on the full value. A fast screening tool, the 1% rule. Monthly rent should be at least 1% of the purchase price, and the tax benefits are extraordinary. Depreciation lets you write off the building over 27.5 years, even while it's gaining real value. And a 1031 exchange lets you roll proceeds into the next property and defer capital gains taxes indefinitely. Strategy 3. Private lending. Here's one most people never consider. Become the bank. Instead of putting money in a savings account so the bank can lend it out and pocket the spread, lend it directly yourself. Private lenders typically charge 8% to 12% interest to real estate investors or small business owners who need fast capital banks won't move quickly enough to provide. The most common version is hard money lending. The loan is secured by real property, not just a promise. The safety comes from structure. Keep loan to value under 65 to 75% of appraised value, and secure first position lien status, so if the property is sold in foreclosure, you get paid first. Strategy 4. Not everyone wants tenants or 2 a.m. maintenance calls. That's where REITs, real estate investment trusts, come in. A REIT owns large portfolios of income-producing property, and by law must pay out at least 90% of taxable income to shareholders. That means REITs often yield 5% to 8% or more annually, and because they trade on the stock market, you get full liquidity, buying or selling in seconds. All the income of real estate, none of the headaches. Strategy 5. Buy boring businesses. Ask most people their dream business and you'll hear tech startups and trendy cafes. Ask the wealthiest cash flow investors and you'll hear laundromats, car washes, vending routes, self-storage, Boring businesses with stable, recession-resistant demand. A well-run laundromat can generate $50,000 to $100,000 a year in net income on a $150,000 to $300,000 investment, a 25% to 35% annual return. The smart move is buying an existing, profitable business rather than starting from zero. You inherit proven cash flow and a real customer base. Just check 3 to 5 years of verified financials first.
Strategy 6. Bonds.
Bonds are boring on purpose. And that's the point. When you buy a bond, you're lending money to a government or company in exchange for a fixed interest payment plus your principal back at maturity. The smartest way to use bonds for steady income is a bond ladder. Buying bonds that mature at staggered intervals, say 1 through 5 years out. As each one matures, you reinvest at current rates, protecting you from being locked into one rate while still collecting income the entire time. Beyond the big six, there's a whole world of alternative income. Royalties pay you for intellectual property, music, books, patents, sometimes for decades after the original work is done. Equipment leasing lets you buy machinery and lease it to businesses, often returning 10% to 15% or more, secured by the equipment itself. And digital assets, monetized websites, online courses, paid newsletters, can generate recurring income with minimal ongoing time once built. Every investment can be measured on 3 things: cash flow, money arriving now; appreciation, value growing later; and liquidity, how fast you can cash out. There's no perfect investment that maxes all 3. The skill is in the blend. Imagine someone with $300,000 in idle cash, split 3 ways: $100,000 into dividend stocks at 4% yield, $4,000 per year; $100,000 as a 25% down payment on a $400,000 rental, netting $18,000 per year; and $100,000 as a private loan at 10% interest, generating $10,000 per year. Total first-year passive income, $32,000, a 10.7% return from 3 completely different sources. Reinvested, that portfolio can roughly double every 6 to 7 years. Building a cash-flowing portfolio is only half the job. Protecting it from common mistakes is the other half. Watch for 3 traps. Over-leveraging, borrowing so aggressively that when rents dip or rates rise, you can't service the debt and you're forced to sell at the worst possible time. Yield chasing. Chasing a 15% return when comparable investments pay 5% isn't a better deal, it's a riskier one. Ask what the market is pricing in that you might be missing. And insufficient diversification. Putting too much into one asset means one piece of bad luck, one regulation change, one market shift can wipe out everything. Spread it out. The technical strategies are learnable by anyone, but mindset is what actually separates people who build wealth from people who just talk about it. The wealthy treat every dollar like an employee. No dollar is allowed to sit at a desk doing nothing all day. When the market drops 20% or 30%, most people panic and sell. Wealthy investors see a sale, a chance to buy income-producing assets at a discount, and they build systems so the wealth grows even when they're not paying attention. Automatic dividend reinvestment, property managers handling the day-to-day, automatic contributions from every paycheck. Removing yourself from the daily decision-making is, paradoxically, one of the most powerful things you can do for your long-term results. Here's a line worth remembering. It's not what you make, it's what you keep. Long-term capital gains and qualified dividends are taxed at a maximum of 20%, while ordinary income can be taxed up to 37%, meaning the same dollar earned 2 different ways can leave you with very different amounts in your pocket. Real estate depreciation can create a paper loss for tax purposes even while a property generates real, positive cash flow. And legal protection matters just as much as tax efficiency. An LLC separates your personal assets from your investment risk, so a lawsuit tied to a rental property can't reach your personal bank account or your home. For those thinking long-term, trusts allow wealth to pass to the next generation without the delay, cost, and public exposure of probate court. The best time to start turning idle cash into cash-flowing assets was yesterday. The second best time is today, not next month when you've done more research, not next year when the market feels better. Conditions are never perfect, and the investor who waits for perfect certainty waits forever. Pick the one strategy from this list that fits your knowledge, your risk tolerance, and the capital you actually have. Start small, learn as you go, reinvest your early returns, add a second income stream, then a third. Build the systems that make it automatic, and let compounding do the heavy lifting for the rest of your life. Your idle cash deserves better than sitting still. Your future self deserves better. Stop letting your money sleep. The time to act is now.